Hi, Chapter 8 is going to be unique, and Chapter 8 is going to be special because it is the place where we're going to begin to combine all the tool sets that you've already put together. Chapter 8 is a great place to show you where the application of this stuff actually gets put into place in a capital corporate environment. And so here in front of you, what we see is an investment. This is an initial investment. If you start a business, you're going to have to invest something into it. And so this initial investment is how much money you put into the purchase of a large piece of machinery or a piece of real estate property or whatever it is that you are starting to begin. It's going to call you something. And in the book, in Chapter 8, we see that this is one of the continual examples. So this is a really good set of numbers to use if you're paralleling me with the Megasin book. So in this case, we're making a $250 million initial investment, and then we see a series of cash flows that occur after the investment has been made. I like to use the example here. I like to call this a hospital. I don't remember what the book uses exactly, but here we can call this a $250 million investment to build and manage a hospital. And then every year thereafter, you get a series of cash flows. Now, the first thing that we look at is that this is not this is not a payment. Okay. Why is it not a payment? Because the cash flows are irregular. That means that these cash flows are uneven, or they can be considered to be irregular. To that end, we can't use our traditional cash flow. We can't use our traditional time value cheat sheet. We have to use the irregular cash flows, or in this case, our net present value systems, or something else. We have to use a series of different types of techniques that allow us to try to value whether or not, or to value these cash flows given the initial investment. And so that's basically what we're going to do. We're going to try to figure out whether this is a good idea or not. And in the book, we look at five different systems, so to speak. So we'll be covering in other videos, and in this one, 5 systems. The first one is going to be accounting rate of return. Accounting rate of return, which parallels ROA. Okay, this is basically net income over the initial investment, or total assets, or however it is that we're trying to construct that. Number 2 is called the payback period, or the payback method. This is the most common one that we see when we're out walking around in the world. We can turn around and say, well, I'm going to start a business, and it's going to take me, I'm going to put $10,000 into it, and it's going to take me, 3.5 years before I get back my initial investment. In this case, we make an initial investment, and we figure out how much time before we get the initial investment back, right? So I'm going to make this into a clock. How much time before we get it back? Number 3 should be no surprise. It is net present value. And there are some differences between the way we calculate net present value here, because we have an initial investment at time period 0. But we'll get to those in a separate video when we get into the details. Number 4 is the internal rate of return. Internal rate of return. Okay, and that is very similar to net present value, but just a little bit different. We'll discuss how. Here at net present value, I'm looking for an answer in terms of dollars, or how much the value of the cash flows are. And internal rate of return, I'm looking for an answer in terms of percentages. This should be no big surprise. And finally, we're going to talk about the profitability index. In this case, the answer is just a number. There's nothing particularly special about it, but we can talk about that as we move forward. I'm going to try to do one video on each of these. So hopefully, if I have enough time, we'll get 5 additional videos here, and you can work them one at a time. I'll do each of them with the practice problem, and I'll do each of them with both this example, the $250 million example, and potentially with the $50 million example that we have. So why is capital budgeting important? Okay, why is this something that we actually want to spend some time on? Capital budgeting is important because a firm only has so much money. Okay, a firm has a certain amount of money, and they're often presented with different projects, Project A or Project B, and we'll refer to these as projects. And those projects are going to have different cash flows. For example, my time period 0 initial investment for this one might be negative 250 million, and the other one should be or could be 50 million. And then I'm going to look at what the cash flows are at time periods 1, 2, 3, 4, and so on to see whether or not they're a good idea. If the cash flows at A justify a $250 million investment, then maybe I want to consider Project A. If the cash flows for B, maybe I can consider Project B. The problem here is that, as we'll find out in later chapters, I'm limited by a certain amount of money. And so I need to value whether or not these are good investments. But before I do that, I need to value whether or not each of these is, let me do it this way, is each a good investment? Is each a good investment? So if I were to go back to my other example and put in the dollar amounts here, 30 million and 80. No, wait, that's not right. Let's back this up a little bit. 35, I was close. 35 million and 80 and 130 and 160. I need to evaluate if these cash flows as a group over time not only reimburse me for the $250, but I also need to make sure that if I discount these back in time, the way I've been doing all my discounting, that those cash flows are worth something appropriate back in time. Okay, what is that value? And so if this is a good investment, then I need to make sure that I'm not only making my money back, but that I want to elect this project. The real problem here is that over time, what ends up happening is that you end up with Project C and Project D and the purchase of a new company or a new product line, or maybe if those returns aren't what I want them to be, maybe I just invest into the stock market. And it's safer to invest into the stock market than it is to do a new business. And if that's the case, well, we've got other problems. The point is that firms have a certain amount of money. They have all these different projects to choose from. And what we're going to do by looking at these five processes is teach you not only what the process looks like and how they're done, but why they're valuable, and more importantly, which one of these I'm going to choose when I'm evaluating new projects.